As a financial advisor, I get this question all the time. What's better, a Roth or traditional account? It's a difficult decision, and as a result, I see most people get so confused that they end up just splitting it down the middle, 50% Roth and 50% traditional, or they go all in on Roth because some guy on a podcast told them to do that. But the research shows that there is an optimal way to do this, and it has a multi-six-figure impact. And it is not by splitting contributions every year. There is a lot of research behind this, and I have been through all of it. I'm about to dive into 3 hours of research at least. So in today's video, I'm going to share the framework that I use with my clients and even myself, and I'll show you the numbers behind it. This is the ultimate guide on traditional versus Roth. By the end of this video, you will be an expert on the subject, but most importantly, you will know how to make this decision for yourself. For this decision, we need to start off with understanding what we want to accomplish. We are striving for tax arbitrage here. That's a fancy way of saying we are attempting to profit from the difference in tax rates. With a traditional account, money goes in pre-tax, so you avoid tax in the current year. It grows tax deferred, and then finally, when the money comes out later, you will pay tax then. With Roth, it's the opposite. Money goes in after tax, so you pay tax in the current year. It grows tax-free and comes out tax-free when you take the money out. So both accounts give you decades of compounding with zero interruption from taxes. So the question we have to ask ourselves is, do we want to pay tax today when putting the money in? Or do we want to pay tax in the future when taking the money out? If you anticipate your tax rate increasing in the future, you would choose to pay tax today. So that would mean you would go Roth. On the other hand, if you anticipate your tax rate decreasing in the future, you want to pay tax later, so you would go with a traditional account. If tax rates stay the same, it doesn't matter which way you go. This is what I see most people get wrong. But that's it. Just locate the year that has the lower tax rate. Simple, right? No, unfortunately, it's not that simple because this equation has a lot of variables. What if tax rates increase? What if tax laws change? What if I retire at 60 instead of 50? What if I move states? There's so much to think about with this decision, but here's something to understand about taxes that I find 99% of people don't get. Tax rates changing does matter. If the 24% bracket suddenly becomes the 32% bracket, that's going to sting. But tax law changes matter just as much. And tax law is what gives you deductions and credits. So if you jump from the 24% to the 32% bracket, but Congress also increases the standard deduction and child tax credits, your effective tax rate actually may stay the same. And that's what we've seen throughout history. While tax rates have been all over the place, and I'm talking as high as 90% at one point, effective tax rates have stayed relatively stable. And that's because tax laws have moved in step with changes in tax rates. So tax rates increase, you get more deductions. Tax rates decrease, you might get less deductions. Now that you are well versed in taxes, let's jump right into the framework on Roth versus traditional. This framework has 3 steps. Okay, so step 1 is to start with a rule of thumb. Look, I'm typically not a fan of rule of thumbs with money because personal finance is and should be personal, but it's not a bad starting point at times. So here's the rule of thumb. If you are in the 10 to 12% bracket, we're going to go Roth. If you are in the 22 to 24% bracket, we're going to say you can go either way, Roth or traditional. But if you are in the 32% bracket or higher, we're going to say go traditional. But we cannot stop here. Remember I said earlier that this decision could have a multi-six-figure impact to your wealth, but we have to go on to figure that out. Step 2 is to customize this rule of thumb to you. The reason this is important is because one person's 24% bracket might be their high peak bracket, while to another person, 24% might be a low bracket. There are 2 effective ways to customize this rule of thumb to you. First, let's figure out where you are in your career. If we view our career as having 3 phases roughly, beginning, middle, and peak earning years, we can start to figure out where we are. If you're in your 20s, there's a good chance you're still in the beginning of your career and your peak earning years are somewhere down the road. If we look at the statistics, we see that the biggest jump in earnings is when we move from the 25 to 34 year age range to 34 to 44 years old. So millennials and Gen X actually saw about a 20% increase in income when moving from those age ranges. So again, 24% at 25 years old means something completely different to somebody who is 45 years old, who's also in the 24% bracket. For the 25-year-old who is just starting out, again, that might be their low tax bracket, while the 45-year-old might be in their peak earnings bracket. The second way to customize this to you is to look at your spending. How much of your income are you spending? If you're in the 37% bracket, but you're only spending $100,000 a year, we know that when you retire, you're going to really drop tax brackets. And this is before we get into all of the strategies that we can use to keep income low in retirement. But the biggest impact to your wealth is the next step, step 3. And this is to watch for big swings. So the research from Michael Kitchus found that the largest impact to your wealth was not diversifying between Roth and traditional every year, but going all in on one when there are large changes to your income. So this approach is to take this decision year by year and actually time it. We're going to go traditional in the years income jumps up and Roth in the years where income drops. I'll show you the impact in a second, but let's talk through what are big changes in income. Well, your income could go way up one year through a bonus at work, a liquidity event like a sale of the company, marrying a high earning spouse, or on the other hand, your income could drop. That could be a leap to entrepreneurship or a spouse becoming a stay-at-home parent. What we want to do is jump on these opportunities. And the easiest way to do this is to pay attention to the tax bracket swings. So when we look at the federal tax brackets, you can see the largest increases are when we go from 12 to 22%. And 24 to 32%. Pay very close attention when your income is between those two brackets. Moving to or away from a high tax state could also create a big change in your tax bracket. This strategy is called Roth optimized strategy. Well, we're going to walk through an example here to show you the impact. Let's say a couple use the strategy by deciding to do this. They are going to do Roth when they are in the 10 to 12% bracket. They are going to split Roth and traditional. So yes, a 50-50 split when they are in the 22 or 24% bracket. And then they're going to do traditional when they are in the 32% bracket or higher. What are the results? Well, by using this strategy, they created an additional $400,000 in wealth. Yes, this is a timing strategy. But unlike trying to time the market, this timing strategy works because you have a really good idea of what a low income year is for you and what a high income year is for you. Personally, when I made the leap to entrepreneurship, I switched completely to Roth. I also did Roth conversions because my income dropped so much. You see, as we go throughout our careers, our lives, we might have irregular income years. So you start your first job and then a few years later, you get married to a high earning spouse. Then one of you leaves your job to pursue entrepreneurship. Then you get a big bonus at work. Then the business takes off and one of you leaves your job to take care of your children full time. Then you return to work and then you get laid off and you move to a high state income tax. There's so many changes. And the important part of this strategy is that we jump on them when they present themselves. So these extreme high or low years, this is when you really take advantage of tax arbitrage. And like I mentioned earlier, if there's a year where your income really drops, like potentially goes to zero, you may even explore Roth conversions, going from traditional to Roth accounts. This is taking money from a traditional IRA and converting it over to the Roth, which is a taxable event. But it might be a good idea if you can get money into the Roth accounts at a low tax bracket. The outcome of this strategy is not to have 100% traditional or 100% Roth accounts. The best thing to do when you go into retirement or you need to start taking money out is to still have a combination of these accounts, traditional, Roth, and taxable as well. The idea behind that is because we want to control our marginal tax bracket in retirement. So while it might be worth it to jump completely on one in 1 year, again, remember, we still want to be building up a healthy mix of different account types. And honestly, most of us are forced to do a mix anyway. So we might decide that traditional accounts make sense for us. So we max out our traditional 401k and our HSAs, but then we make too much money and we need to do a backdoor Roth IRA. Or we decide it makes sense to max out a Roth 401k, but our employer is matching contributions pre-tax. That mix is a good thing, but the important part is to pay attention to those extreme years, the 10% swings in your tax bracket. Anytime you see that, we want to take advantage of them. That is a wrap on Roth versus traditional. Thank you for watching the video.